Welcome to Countax. In this lesson, we're going to be looking at leases, but specifically from the perspective of the lessor. And this is according to IFRS 16, formerly known as IAS 17. So that is exactly what we're going to pay attention to, how you account for leases on how it's viewed according to the lessor. Now, this is part 1. So we're specifically going to be looking at the theory behind it. And it's important to understand this if you're going to understand how to account for it in the journal entries or in the disclosure in the financial statements or when you're doing the calculations. So firstly, what are leases? Well, a lease is a contract that conveys the right to control the use of an identified asset for a period of time in exchange for consideration. So that obviously definition can be broken down. First of all, you understand that it is a contract that is entered into between the lessor and the lessee, and we will explain what the lessor is just now. And it conveys the right to control the use of an identified asset. So it does grant the right to control the use of an identified asset, and this would be for a period of time in exchange for consideration. In most cases, that consideration would be lease payments, and we'll get into that shortly as well. Well, now that we know what a lease is, well, there are important definitions relating specifically to the lessor as per IFRS 16 that we need to know, right? The first one being a lessor. What is a lessor? Well, it's an entity or a person that provides the right to use an underlying asset for a period of time in exchange for consideration. Well, in other words, this is the person that leases out their asset, all right? They would lease it out to somebody else. They would be known as the lessor. So it can be an entity or a person that provides that right to use the asset for a period of time. And obviously the lessor is the person who will be receiving the lease payments or the consideration that is agreed upon. Now that you know what the lessor is, there are two types of leases. One is a finance lease and a second is an operating lease. Well, a finance lease is a lease that transfers substantially all risks and reward incidental to ownership of the underlying asset. All right, so this is a finance lease. It will transfer substantially all the risks and rewards of the asset to the lessee. Okay, and there is a criteria that we use to determine whether a lease is either a finance lease or an operating lease. And an operating lease in this case is a lease that does not transfer substantially all the risks and rewards incidental to ownership of an underlying asset. Now, it's important to note here that this is from the perspective of the lessor. Remember, they do make this distinction between a finance lease and an operating lease. Unlike a lessee, and we'll have lessons pertaining specifically to a lessee, you'll find the link in the description below, where they do not classify their lease as either finance or operating lease, and that we get into in the other lesson. But for the lessor, they do classify it as a finance or operating lease. So you need to determine, is this a finance lease or an operating lease? And you'll go through the recognition criteria to see which one it is. We've done a lesson specifically looking at the difference between a finance lease and an operating lease. You'll find a link to that lesson as well in the description below. What are some other definitions that we need to know? Well, there is the lease term, all right, how long the lease is for, and this is one of the criteria that you use to determine whether it's a finance lease or an operating lease. Well, it's a non-cancelable period or term for which the lessee has the right to use the asset together with a period covered by an option to extend the contract if there is a reasonable certainty to extend the lease, and an option to terminate the lease if there is reasonable certainty not to exercise that option. So that is what the lease term would cover. Initial direct costs, well, these are incremental costs of obtaining a lease that would not have been incurred if the lease had not been entered into or obtained. That's very important, because an initial direct cost is what is incurred in order to obtain a lease, and this cost would not have been incurred if the lease was not obtained. So it's important to take note of that, because it does have a role to play when you're doing your calculations. All right, and the lessee's incremental borrowing rate, well, we'll also look at this in great detail when we are looking at leases from the perspective of the lessee. But this is the rate of interest the lessee would have to pay to borrow a similar term and with similar security the funds necessary to obtain an asset of a similar value to the right of use asset in a similar economic environment. So that is what the incremental borrowing cost is looking at a rate that you would have had if you had to borrow a similar asset in a situation that is similar to that of the lease. All right. Another important term here is the residual value guarantee. Very, very important. It's a guarantee made to a lessor by a party unrelated to the lessor that the value or part of the value of an underlying asset at the end of a lease will be at least a specified amount. So that's very important. This is a residual value guarantee. All right, and it is a guarantee that is made not by the lessor, the one who is leasing out the asset, or any party related to the lessor. Right, so it's not made by either the lessor or the party related to a lessor, but it's made by someone else, that the value of the asset at the end of the lease will be at least a specified amount. Now we need to pay careful attention to this when we're doing a calculation as well, and you will see when we look at the examples. An unguaranteed residual value is the portion of the residual value of the underlying asset which is not guaranteed by a party unrelated to the lessor or guaranteed solely by a party related to the lessor. So in other words, this unguaranteed residual value, you will be told that it was determined by the lessor or a party that is related specifically to the lessor. Hope that has made sense. All right, you have to pay attention to this. The lessor includes the residual value in its amortization schedule, whether it's guaranteed or unguaranteed. So you might have a guaranteed residual value or an unguaranteed residual value. Either way, you have to include it in your amortization schedule when you're doing your calculations. So remember that, and this is specifically for the lessor. All right. Another important one is the interest rate implicit in the lease. And this is the rate of interest that causes the present value of the lease payments and the unguaranteed residual value to equal the sum of the fair value of the underlying asset and any initial direct cost of the lessor. So this is the rate that you will use to discount your amounts. All right. So it will cause the present value of the lease payments that the lessor will be receiving and the unguaranteed residual value, which we've just explained, to equal the sum of the fair value of the underlying asset and any initial direct cost, which you've just explained as well, of the lessor. All right. So basically, this is the return the lessor is receiving from the lease agreement. All right. So this is the return. So you're saying, what is the rate of interest that the lessor would have charged the lessee? All right. But it's, remember, it's implicit. So we're doing the calculation to determine what that rate would have been. Okay. The inception of the lease, this is the earlier of the date of the lease agreement and the date of commitment by the parties to the principal terms and conditions of the lease. All right. Either the date of the lease agreement or the date of the commitment by the lessor and the lessee to the principal terms and conditions of the lease. And then the commencement date of the lease is also different from the inception of the lease. This is the date on which a lessor makes an underlying asset available for use by a lessee. All right. So remember, the lessor is the one who is leasing the asset out to the lessee. So when is the lessor making that asset available for use by the lessee? Well, that's the commencement date of the lease. All right. And here, the lease payments by a lessee to a lessor relating to the right to use an underlying asset during the lease term include the following. Very important. This will determine whether you get your calculations correctly or incorrectly. Well, it includes the fixed payments, including in substance fixed payments, less any lease incentives. All right. So you have to deduct whatever lease incentives might be given by a lessor to the lessee for entering into this lease. Okay. Another one is the variable lease payments that depend on an index or a rate. We've spoken about the rates just before. And the third one that would be included as part of the lease payments is the exercise price of a purchase option if the lessee is reasonably certain to exercise that option. Amount expected to be payable by the lessee under residual value guarantees would also be included, and payments of penalties for terminating the lease if the lease term reflects the lessee exercising an option to terminate the lease. So if payments may be paid for terminating the lease, we'll also have to include this. So you have to make sure that the statement says that the lease term reflects the lessee exercising that option to terminate the lease, or you will be given the amount. All right. Now let's look at gross investment of the lease, and it includes the following payments. All right. the lease payments receivable by the lessor under a finance lease, including the guaranteed residual value. Remember the guaranteed residual value, any unguaranteed residual value accruing to the lessor. So remember, this is the one that is determined by a lessor or a party related to the lessor, and you'll be told that it's an unguaranteed residual value, or they may not tell you. You just have to know based on the definitions we've given in the previous slides whether it's an unguaranteed or it's a guaranteed residual value. Now let's contrast the gross investment of the lease and the net investment in the lease. Well, this is the gross investment in the lease discounted at the interest rate implicit in the lease, and this will all make sense when we go through an example, and you'll see a link to the example in the description below. So the gross investment in the lease includes the two we've just mentioned, but a net investment in the lease is taking that gross investment in the lease and discounting it at the rate implicit in the lease, and that will give you the net investment in the lease. So let me give you a tip here. The net investment in the lease will be less than the gross investment in the lease because you will have discounted it. All right. So unearned finance income is the difference between the gross investment in the lease and the net investment in the lease. So if you hear the term or you know the term unearned finance income, you know that it's the difference between the gross investment in the lease and the net investment in the lease because you would have discounted it at the rate implicit in the lease, and that is the unearned finance income for the lessor. All right, now this is the theory that you need to understand and you need to pay careful attention to when you're dealing with leases from the perspective of the lessor. I hope it has made sense. I hope you're able to grasp the terms that we just went through. You have gained value from this lesson. If you've learned something, consider subscribing to our channel, like this video, and share it to those you think it might help. See you in the next one.